Hello, Zach Greenewalt with Dryfly Collective Real Estate at Keller Williams, Sun Valley, Southern Idaho. Recently, there's a lot of conversations taking place around, is the housing market going to crash? Are prices going to fall? In today's video, I hope to tackle that question and give you some insight into where the market might be going based on where the market has been. We're going to zoom out here and take a look at the national figures for the U.S. housing market in just 5 slides. This first one we're looking at is home prices annual. This graph shows us that the 4% annual appreciation, we are sitting at about 7.4% above that trend line as it stands right now. Now you can tell if you go back to 2006, we were 21% above that trend line. Now stop and think about this for a second. In 2006, we all thought housing was incredibly expensive. If you had bought in 2006 and held on for the next 2 decades, did you make a good or bad investment? This chart answers it simply. You made a great decision in purchasing at the highest point in pricing that we have going back to 1990. So prices rarely fall unless unemployment goes up, and we're going to touch on that in the upcoming slides. Where does appreciation show up over the decades? 1990 to 2000, normal growth of 4%. 2001 to 2005, things get hot. We are up about 8.9% on appreciation on average. 2006 to 11, we march backwards during that time. That's the housing crash. 2012 to 19, we returned to growth of 6.4%. 2020 to 2022, the COVID years. 2 things to consider here. Incredibly low mortgage rates and remote work. That drove a frenzy into the real estate market that saw valuations go up very quickly. 2023 to 2025, we returned to solid, normal, healthy growth of 2.4%. Some data points along the way here. I think the thing to think about on this one and to know and understand is when inflation goes up, housing tends to calm down. When the cost of borrowing money goes up, housing prices tend to calm down. But you can tell on this graph, they rarely go negative. It's only a couple times that we can see here. 1991, 2009, those markets where the price points actually retreat are when unemployment goes up significantly. Now, I think there's something interesting taking place in the market right now. It's a bit of a wild card. It's AI, right? Now, there's a lot of conversation about what AI will do to our economy, what it will do to the labor force, and what impact it will have on unemployment. This graph shows us very clearly that home prices tend to appreciate over time. The only times they tend to go backwards are when unemployment goes up. So we need to keep an eye on what might happen with AI and our employment numbers. Fed policy and mortgage rates. What does this mean for you? This is the Fed fund rate. So when the federal funds rate is set, it gives us kind of a parameter at which banks will borrow money, the cost at which the banks will borrow money. The banks then in turn lend money to consumers, you and I, to purchase homes. Now there is a correlation between the risk of lending money and what's happening in the market. So let's spend just a moment looking at this in depth. I think this will help give some clarity around what this graph shows us. 2009, you can tell leading into that market, the Fed's fund rate was at 5.41%. So if a bank were going to borrow money, it would be around that marker, and they were lending at about 6.22%. Okay, that's what it was at to get a 30-year mortgage in about 2007. The Fed's fund rate drops 5.3% to 0.07%. What does the 30-year mortgage do though? Stays at about 5%. Why would the Fed's fund rate drop so low and yet the mortgage rate remain the same? Simple. There was a lot of risk to lend money in 2008, 9, 10, 11. Unemployment was high and it was sticky at that time. Means there weren't a lot of jobs. It was risky to lend money. Now you can tell between 2009 and 2017, we kept that Fed fund rate very low. It raises to 2.45% in 2019, and then COVID happens. Interest rates, the Fed funds rate drops to 0.05%. Now, we all thought the world was going to end, and the opposite happened. The economy took off, remote work showed up, people were moving and living where they wanted to. Unemployment did not go through the roof, only briefly during that first April. So the economy is quite strong. The labor force is in full effect, and you can tell there's very little risk in lending money. So we have a 0.05% Fed funds rate and mortgage rates sitting below 3%. I hope you can understand how those two things correlate, right? Risk, how risky is it to lend money? Now, if we want to know where the 30-year mortgage rate is going, it is very valuable to know what the 10-year Treasury yield is going to do. These two numbers move in near lockstep with each other. So the 10-year Treasury today is sitting at about 4.21%, and the mortgage rates for 30 years are sitting at about 6.1%. If you want to understand where mortgage rates are going, go look at the 10-year Treasury and you'll understand what's going to happen in that marketplace. Now, all this information is helpful, I believe, and it gives you an idea of what might happen with the housing market. I think the wild card and the thing to keep in our back pocket and pay attention to is unemployment. What we typically see is housing prices tend not to retreat unless unemployment goes up significantly. That's the AI question. What will happen with that? Housing prices tend to calm down as inflation and wages rise. So the question on, will the housing market crash? History shows us one thing. And unless that unemployment number upticks, we should be on solid footing. We'll see what happens. Now, all these numbers are valuable to understand and get a sense of what the headlines might read nationally. But if you're considering selling locally, what does that mean for you? You need to have a local strategy. That's the most important thing. If you're considering buying or selling right now, I would love to meet with you and talk about how these numbers directly impact you. These numbers don't tell me we're looking at a crash. They tell me we're looking at a rebalancing. I hope you find this valuable information. Again, this is Zach Greenwald with Dry Fly Collective Real Estate.